In this episode of In the Know, you'll learn about oil prices skyrocketing, private credit, disarray, Claude, mind-blowing, and green shoots in the economy. All right. Greetings, everyone. Welcome to In the Know. This is Employment Friday. So we have a lot to discuss. I'm going to change things up a little bit this week because there is so much drama taking place in the world. So we'll first start out talking about Iran and the Middle East, private credit. Those are the two big worries, I would say, today. And we'll also talk a little bit about Claude and sort of a back to the future or deja vu moment that I had this week. So first, Iran. Now, what we are hearing, and of course, we're not hearing everything, and we don't know everything, of course, but from what observers are observing, including the Hudson Institute and others, is that the Iran's firing of missiles and sending out drones, that has dropped by about 90%. So Iran has been weakened considerably. And so we can think about a couple of scenarios now. One is that this young, well-educated population is going to behave like a coiled spring. We know that they have two other times in two different administrations here in the United States. They have been protesting and looking for a way out of a repressive regime. Now, I know not everyone in that country feels that way, but we do get the sense that young people do. And so they have been waiting for freedom. And we think this could be, and I use coiled spring a lot because we talk about innovation that way. So you've got a coiled spring in terms of a population just really wanting to join this very exciting world, especially the world of technology and innovation. And this world of technology and innovation itself is also a coiled spring. Slowly, then all at once. And we are having a lot of all at once moments now. So I think this could be really good for the Middle East in general and as a region, because we know that the UAE and Saudi Arabia are very focused on innovation. They know that oil prices are going down as autonomous mobility takes us into the electric vehicle realm. Electric vehicles will be less expensive. And that means that the oil price will probably come down. Right now, it is close to $90. It has soared about 50% since this conflagration started. And we could see it going down below $50 per barrel. Right now, as I said, it's $90 per barrel, below $50 per barrel, and perhaps much lower over the next 5 to 10 years. The Middle East, which has the largest oil reserves, knows this, and so they've been diversifying into really technology-based disruptive innovation. And so it's becoming a very interesting region from that point of view. Of course, if something goes wrong, well, I don't think we're worse off, except for, of course, the people who have lost their lives and wartime being a horrible thing. But in terms of how the future will play out, I don't think if this regime somehow manages to hold on, that the world will be that much different. So I guess we're looking at status quo or a big surprise in terms of growth and innovation on the upside of expectations. So that's Iran. Private credit is the other worry today. There's about $1.8 trillion in private credit today, and a lot of it is in interval funds and funds that don't allow full redemption at any time. They might allow inflows, but not redemptions. And I think because of a few bankruptcies, highly publicized bankruptcies, one clearly related to fraud, this market has become unsettled. Just today, BlackRock decided not to satisfy the 7.9% in redemptions from its largest private credit fund. It only allowed 5%. I might be wrong on that 7.9%. There may have been requests for 9.3. In fact, I think that's right, 9.3%. They only allowed 5%, so roughly half. So there are a lot of nervous individuals who thought they were buying funds that were guaranteeing dividends in the 10 to 12% range, and they just felt safe. It was bond-like. But whenever you see outsized guarantees like that, 10, 11% dividend yields, when the treasury yield out there is 4%, you have to know you're taking some kind of risk. And the risk here is bankruptcies. Now, these companies have been used to adjustable rates. These interest rates go up with the Fed funds rate. But I think the problem now, since many of these companies started and or were funded around COVID, we're now in the 5 to 7 year window where they'll want to roll over the debt, and that's not going to be possible in this new world. Many of these companies are being disrupted by technology. SaaS is a great example. A lot of private credit and private equity firms started buying SaaS companies. Well, guess what? SaaS is being disrupted by the frontier models out there right now and by platform as a service companies like Palantir. So 11 to 12% dividend yields, those were not risk-free at all. And so here we're learning, again, an important lesson. Now, one of the things we have to ask as far as private credit goes is, could there be a systemic problem? Systemic usually involves the banking system, the highly leveraged banking system. And what we're learning is the banks are not, at least as far as we know so far, highly exposed to this area of the market. We can see this in the market as well from credit default swaps on individual banks. They have remained very low. So credit default swaps are insurance policies against something going really wrong with these banks. And I'll show you in a chart in a few minutes that CDSs are very well behaved in the banking sector. And in the high yield world, so this is junk bonds, if you look at the spreads of those yields relative to treasury yields, those are also very well behaved. And given the amount of drama taking place out there, you would think if there were to be a systemic problem, that those CDSs and the high yields would pick up on it. So we're feeling pretty good about that. And then before we get to the charts, I'll just talk a little bit about an aha moment we had this week here in St. Petersburg. We had our offsite, so we had partners from around the world, Japan, Taiwan, Korea, Australia, I think, was represented, many countries in Europe, the UK, and our partners here in the US come to visit us so that they could be steeped in our research. And as we were walking around and making introductions, it was very clear that there was, I call it a PC moment. In 1980, when IBM put out its first PC and Apple put out Lisa, many people probably don't even know about Lisa, there was this kind of a moment where everybody in the firm gathered around a desk to see what this was and, to marvel at it, at what it could do. And back then, all it could do was really addition and subtraction and very low-level things. And look where we are now. Well, we had the same moment with Claude. The Claude, I think it's Claude work or Claude code work, where someone on our finance team was just blown away by how quickly he was able to automate all of these automation projects that he had lined up over the past 6 months. We're on Palantir, and so we're certainly going to integrate all of that with Palantir. But he was able to do this individually, and he was shocked, and everyone around him was shocked at how beautiful the graphics were, the tables, and how perfect they were, and even cross-checking the numbers with some manual additions, subtractions, percentages. They were correct. So another PC-like moment, and that PC-like moment was 46 years ago. So technology, disruptive innovation, we've been waiting for many, many years, slowly, then all at once, for these technologies that we've been focusing on, the seeds of which were planted in the 20 years that started with the PC and ended with the tech and telecom bubble and bust. Those seeds were planted. They weren't ready to flourish. They've been germinating. We got the cloud in '06. We got the first really big breakthrough in AI in decades, so deep learning, ImageNet. We got an even more provocative breakthrough with transformer architecture in 2017. And now that slowly is turning to all at once, not only because the technologies are ready, but because they are converging with one another. So it's a pretty exciting time. And we got some interesting news today. It seems as though because of the impending talks, and we don't know what's going on behind the scenes, between China and the U.S., and it may even be President Xi Jinping and President Trump, Boeing got an order today for 500 planes. Now, that speaks volumes to us. Why? Because we know that there is what some have called the axis of evil. And so it's Russia, North Korea, Iran, and China. But look what just happened. We are negotiating and doing business with China when one of its biggest allies, or at least part of that axis, is under attack. I think that says that the negotiations between China and the U.S. are going along much better than anyone knew. So that's also very interesting in terms of understanding why the stock market and the various bond markets are not, they've been a little volatile over the last week, but they haven't capitulated. You have a down day and an up day, and so it's because this kind of news is leaking out, and I think it's very positive. So now, before we go into the charts, what I'd like to do is, it is Employment Friday, and to be honest, the government's employment statistics are becoming pretty useless. So it's kind of hilarious that we started doing this because of Employment Friday. Nonetheless, they affect the markets, and over time, I think that impact will diminish because these numbers are revised down or up, but mostly recently down. Now, what's so interesting is non-farm payroll employment dropped 92,000. It was supposed to be up 55,000 based on all of the other employment indicators out there, which are all pointing up. So the ISM index employment indicators for both the manufacturing and service sectors, initial claims are quiescent. And just ADP reports have come, now they're reporting weekly and they've been up every week. And so this Bureau of Labor Statistics report is beginning to look a little ridiculous. We mentioned during the last In the Know that last year the non-farm payroll employment numbers were revised down for the year by 865,000. That took away employment gains for many months when we thought employment was stronger than expected. It took those numbers way down. Now, there is another statistic. It's called household employment that comes out on the same day. It's more reliable. It includes many more small businesses. And it, too, was down. It was down, I believe, at 185,000. Now, there was the Kaiser Permanente strike that impacted both. And there was very bad weather, so that's absolutely a consideration as well. But it does seem that employment is being revised down regularly, including last month. I think if I'm not mistaken, the downward revision was 69,000 for the last 2 months. So, it is getting to be kind of ridiculous. But the household employment number rarely is revised. They do, I think it's a 5-year revision, but they do revisions quite infrequently. And that number was revised down by 1.4 million jobs for last year. Now, it corroborates what we've been thinking. These downward revisions are partly a function of productivity growth being much higher than expected. And so what does it mean? GDP really is not being revised. So when you revise down employment, in order to get the same amount of GDP, productivity has to have increased. And so there is a structural shift taking place in productivity. And this is very important to our thesis that technologically enabled disruptive innovation is going to cause a step function increase in productivity. We would not be surprised to see it go from roughly 2%, where it has averaged for the last few years, up to 5%. And when productivity increases, inflation tends to decrease. So it's a Goldilocks world. And I think that's another reason the markets have been buoyed here. I think many people are surprised by the wall of worry that the markets have been climbing, especially since this administration started in January of last year. Of course, we went through tariff terror. We used to call it turmoil, but back then in April it was terror, and a lot of people were unnerved. And then we have the government shutdown, and now we have the war and a little bit of a government shutdown. So a lot of disturbances, but the market continues to power along. It's not a smooth ride, to be sure, but it has been hitting all-time highs. And I do think this productivity story is a very important reason. So now I'm just going to go through a few of the statistics that came out during the last month that are suggesting some green shoots, sort of this rolling recession turning into a rolling recovery, probably one with much higher productivity than anyone appreciated, and that we expect to translate during this year and into next year into a productivity-driven boom in economic activity. So in terms of activity, the green shoots are, while many housing indicators look terrible, the existing home sales dropped 8.4% in January to 3.9 million units. I mean, this is going back to the 70s levels. The population's much bigger now, but housing starts and permits popped. So something's starting to stir in the housing market, and it could be mortgage rates dropping below, at least tentatively below, 6%. That's very interesting. We also saw new orders for new capital good orders, excluding aircraft and defense. So really getting at that underlying capital spending. Those numbers have been month by month coming in at 0.6. This is month to month, so sequential. That would be 7.5% annualized. Up to 0.8%, that'd be almost 10% annualized. So capital spending is continuing to gain momentum. And of course, data centers and the power associated with data centers have been a large part of it. What we are beginning to see other categories of capital spending pick up. So again, green shoots. And capital spending has or carries with it a very high multiplier. What does that mean? And so does housing, as a matter of fact. The multiplier is the amount of added activity other than the actual housing and capital spending. What services around it are created, and what employment with that. We've seen industrial production pick up to 0.7%. Again, that's 8 to 9% annualized. Now, we are at the beginning of the year. Weather distorts, but that was a January number, and weather was not good, so that may even be understated. We've seen the ISM for manufacturing much better than expected orders. On the other hand, the ISM for services has been trending down. And we'll go through that in some of the charts. Autos came in stronger than expected, 15.7 million units at an annual rate versus the prior month, 14.85 million. We're still not back to that 2021, which would have been normal, but we don't think we're going to have a normal auto cycle now that autonomous mobility is starting to take off and the capacity utilization of autonomous vehicles is going to be much higher than the capacity utilization of a personal vehicle. So think 4 to 5% for personal and 50% plus, so 10 times the capacity utilization of a personal vehicle. We did see leading indicators continuing to decline. Those declines are, I think they're now into their third year, which is pretty amazing. We saw the trade deficit deteriorate, and we'll show this in charts. But for an interesting reason, imports are booming. That says something's going on here in the United States. Another green shoot. Our exports are declining. What's going on with that? Certainly it's tariffs and retaliation thereof. But maybe other countries are much weaker than we know. We're still looking at that metals to gold ratio and saying, what the heck is going on? And we suspect it is China. We did get a retail sales report today or yesterday, down 0.2%, so that's the negative. But very interestingly, the deflator for that retail sales was minus 0.2%. So that's inflation went negative. And as you know, we're expecting much more of that. And what does that mean? That report of retail sales minus 0.2 really was flat when adjusted for inflation. It means that purchasing power went up a bit. Not a great report, but a little bit of a green shoot there as well. And then on inflation, we got, and we'll show this in the charts as well, we got a mixture of news. On the PPI side, or PPI related, higher than expected inflation. On the consumer inflation side, lower than expected. So with that, I am going to start going through the charts. This is the usual drill. And we'll start with the deficit. And the reason we're starting here, well, we usually do fiscal policy, monetary policy, economic statistics, market statistics. So this, of course, is fiscal policy. And one of the reasons we featured it first is because the bond market has been very concerned about the deficit. The federal deficit, as the government issues more and more debt, the tendency is for prices to go down of Treasury bonds and interest rates to go up. It's been very interesting to see since I think it was September of, I'm going to say 24. That's when the 10-year Treasury yield peaked at 5% and when the deficit was the talk of the town in bond land. Well, what you can see here is the deficit is improving, and that's without the rolling recession really turning into much of a boom. When it does, we think it's going to close to that 3% mark, which Treasury Secretary Bessent is aiming to achieve by the end of 28. So we think the surprise is that they're going to do better than that. They'll probably be able to get it down closer to zero. Already we see progress. We're about to crack the 5% mark. And you can see how crazy it was during COVID. But you can also see in the early 80s, which is when I was very young in the business, 5% was where the bond market freaked out. And you can see what happened. It slowly moved up as really we were in the PC revolution. Took a while for software to kick in, but the growth rate of the economy accelerated, and that was a big way that we got down to that 3% mark. Okay, the next chart is the trade deficit. Now, in the 80s, the twin deficits were the federal deficit, so government, and the trade deficit. The thinking back then and the fear was if we're running a huge trade deficit, then that means that we're spewing dollars into the system, and the risk is that the dollar is going to go down. And we're beginning, and that's part of the narrative today, too. Many people believe that we're going to continue to run trade deficits, and this is a very bad thing because it will weaken the dollar. We do not agree with that at all. We think just like in the early 80s that the trade deficit, and we don't have it on this one, but anyway, the trade deficit was not the relevant variable. The trade deficit gave way to tax policy in terms of importance. And in the Reagan administration, cutting tax rates, using accelerated depreciation and other incentives to attract foreign direct investment to the United States got our economy revved up and increased the return on invested capital here in the United States relative to that in the rest of the world. And so our dollar soared. And in fact, it might be on the next picture. Yes, it is. So you can see what happened in the early 80s. the dollar soared as the returns on invested capital in the United States moved up dramatically. And it soared to such a high level that emerging markets were in a great deal of pain because they had so much dollar-denominated debt that they needed to surface Treasury authorities and monetary authorities from around the world really came together in the Plaza and Louvre Accords and agreed that the dollar had hit too deflationary a level. It was going to cause deflation everywhere. And so you can see what happened after that. Now, it might have gone down too far after that, but if you take away that burst in the early 80s, you can see where we are today. We're not at the bottom of the range. Many people used last year's decline to say U.S. exceptionalism is dead, the dollar's in decline, and I think, as you can see, it has held at what technicians would call support. And I really think its next big move is to the upside. And that will help with our negative inflation story here in the United States. But the burden of proof is on us, of course. So here's the next one, moving into monetary policy. Interestingly, the purple line there is M2 growth on a year-over-year basis. It has slipped from 4.6% to 4.3% I think that's a January reading. And the CPI, not as clear here, but the CPI also came in lower than expected. It was 0.2% month to month, so that's a 2.4% annualized rate, and it's a 2.4% year-over-year rate. Now, one of the questions we're asking is, okay, velocity helped us when money growth went negative. Velocity picked up dramatically, the rate at which money turns over. Velocity is flattening out, but if our estimate for the first quarter is right, it's probably not declining. And that's important because 4.3% year-over-year growth in money, if velocity were declining, would take some of the power out of that money growth. If velocity were down 1%, for example, on a year-over-year basis, then real GDP, given the 4.3% M2 increase, nominal GDP would be up only 3.3%, not leaving very much room for growth and inflation to coexist. And as you know, we think real growth is going to dominate and that inflation is going to fade away. Here is more on monetary policy on the next page. This is the yield curve at the short end of the curve. So this is the 2-year Treasury yield minus the 3-month Treasury rate. And you can see that is in negative territory still, which means despite what you hear from the Fed and from observers of monetary policy, this means that the Fed is still erring on the side of hawkishness or tight monetary policy. And you can see on the next page the yield curve from a different angle, and I'm fascinated by this one. You can see that trend line down there. That's an important message, we think. But before we get there, you can see during past recessions, which are shaded here, that the yield curve steepened quite significantly. And for the past 30 years, got into the 200 to 300 basis point range. In other words, 10-year Treasury yield at least 200 to 300 basis points higher than the 2-year Treasury yield. So we found what happened after COVID very interesting, and during COVID, that the yield curve did not go back to that 200 to 300 basis point range. And we thought that meant something, we just didn't know what it meant. And so here we are We're in another period of monetary easing, and we got into, I think we might have gotten up to 70 basis points positive. And now we've slipped back to 55% basis points. Why are we focused on this? It's because we did study the last technology revolution in the 50 years that ended in the late 20s, 1920s, that is. So that was railroad, telephone, electricity, internal combustion engine. And if you look back then, the yield curve was inverted more than half of the time, I think well more than half of the time, and the average inversion was 100 basis points, so 100 basis points negative. So stay tuned. Let's see what happens if we're in the same kind of environment. So now we'll segue into unit labor costs, which have been helped dramatically by productivity growth. So unit labor costs are compensation per man-hour, so the year-over-year percent change in compensation per man-hour, minus the year-over-year change in productivity growth. So here you can see it's still roughly in the 1.2 to 1.3% range. Very different from the 70s, and that is when monetary policy went awry because we went off the gold exchange standard. It was unhinged, not hinged to anything, and went out of control. Volcker battled it in the 80s, but it was a very challenging time. We don't have that problem now, and I wish the Fed would talk more about this. And if we're right, and productivity growth is going to continue accelerating from roughly 2% now to 5%, while wages are in the 3.5% range, we could end up with negative unit labor cost growth. So stay tuned here for this one as well. Here we're comparing productivity by country. And you can see the U.S., how much more productive the U.S. is relative to other countries. We have Japan and a few European countries here. And you'll also note during the last few years, productivity in the United States has been increasing relative to elsewhere in the world, which is very interesting. I think regulations in the rest of the world are impeding the uptake of new technologies. And we think AI is a very important one of those. Regulations are strangling AI adoption in many European countries because they're facing country-by-country regulation and EU regulation. And I've mentioned here before, Palantir has pulled out of much of Europe, pulled its employees out. It's just not possible to do business there. And I do think Europe is beginning to understand this. And whenever I go over there, it's top of mind question. But even here in the United States, we're facing a challenge. We heard during Brainstorm today that the odds that a bill going through the New York legislature could pass, and it will prevent companies from using AI or large language models. That's crazy. That's crazy. And if that happens, I guarantee you that Florida and Texas and Tennessee and Nevada are going to enjoy more in-migration. Because I think many people involved in any kind of innovation will understand that their own careers will be stunted if they don't get on this AI bandwagon. Heavily unionized states are at risk of this, so California might follow New York. I have no idea if this is going to pass, but if it does, New York can expect a lot more out-migration. So now we'll shift to inflation by another metric, a very important metric right now. Updated for today, this 3-month moving average of oil prices, the year-over-year percent change in that measure of oil prices, is down roughly 13.5%. Now, that tells you that this recent increase to $85 to $90 hasn't had a lot of time to work into this 3-month moving average. The longer it is sustained, the closer we'll get to zero. And on a year-over-year basis, if we compared today's price to a year ago's price, I think the number is well over 30%, or it's around 30% on a year-over-year basis. So we certainly don't want that to happen. If it does, it's a massive tax increase, and it will be offsetting a lot of the tax stimulus that we're enjoying this year. But it wouldn't be good. As I mentioned in the beginning of In the Know, we do think that this will be short-lived. So again, stay tuned. It is a risk. Here is, I think, a very important set of metrics. You've got the CPI in purple and the PPI in green. And you can see very recently the PPI inflation is outpacing CPI inflation. And what that means, you can see how unusual that is from this chart. But what that means is margins squeezed at the consumer end of the spectrum. So again, watch out for earnings reports where this could become a problem. You can see how after COVID it was a real problem with the supply shock, all the supply chain issues. This war in the Middle East could be stirring this metric, this idea of margin compression, once again. So again, stay tuned. Here, and this incorporates day-to-day. This is Truflation, U.S. Truflation daily. And you can see it's roughly 1%. It has resolved to the downside. There was a tug of war between 2 and 3%, just like we're seeing from the government's metrics. This one resolved to the downside. Now, of course, oil prices, if they get into airfares and into gasoline, this will go up. But as I mentioned, we think it will be temporary. And here you can see a green shoot out of the manufacturing sector. This is pretty decisive, and I think what it's suggesting is that inventories have been drawn down. After 3 years of contraction in manufacturing in the U.S., inventories have probably been drawn down to a point that production has to start again. So here's one green shoot out of that rolling recession. Here's the other side of it. As you'll remember, we were puzzled that the purple line prices on the services side of the ISM were levitating, but the result was activity was getting hit. You can see in green the services output line or orders line, that went negative. Very recently, as the prices have come down, the activity is picking up. So that's another green shoot here, very interestingly. We don't see the green shoot as much in the consumer sentiment data. I'm sure that the employment situation is concerning people. The war and the dramatic headlines we're seeing are a bit unsettling, although you can see very recently a slight pickup, especially in the low-income part of the market. And that's because purchasing power, as measured by Truflation and other metrics, the retail sales deflator, is giving the lower income earners a break in terms of purchasing power. here you can see another reason that confidence has been coming down. This is labor differential. What that means is the difference between jobs easy to get minus jobs hard to get. Jobs hard to get, that metric is going up, while jobs easy to get, or at least relative to jobs easy to get. Now, you can see when this metric goes down as much as it has recently, we are usually in a recession. So we'll continue to call this a rolling recession. And then we'll roll into the next chart, which is another reason for concern. So we've featured this before. The 16 to 24-year-old unemployment rate is 9.5%. At one point, it was 11 to 12%, but it had been revised dramatically, got down to 9%. Now it's moved back up to 9.5%. These are entry-level jobs leaving. This 9.5% compares to the overall unemployment rate of 4.4%. So those entry-level jobs, they're being filled by agents. And I think it's put a lot of fear on the part of parents and grandparents and students themselves into this sense of, oh my gosh, am I going to get a job? Especially because the average duration of employment is 25 weeks. The median duration, which I should also feature, is 11 weeks. So closer to 3 months instead of 6 months, but nonetheless quite a span. And I am getting more excited that this is a blessing in disguise for this cohort, especially for those who, in the meantime, while they're looking for a job, are going to devour as much about AI as they possibly can so that when they do get a job, they'll know more than most of the people in their organization, and they'll be able to really, if the firms allow them, to become a leader much more quickly in terms of inviting efficiencies into companies. I can't tell you what a delight I have watching our young team experiment with Claude, ChatGPT, Grok. You know, it's exciting to see what they're doing with it. And what's even more excited is they are excited. So, you know, it's very interesting with young people and technology. You know, I might get excited about something that they're doing, but they don't. It's de rigueur. They're used to it. When I see them excited and using words like, I'm blown away, even those who, you know, they're chill, they don't get excited by much. That excites me. And so I think if young people do as much as they can to get up to speed in AI, and then even better, if they see a problem out there that frustrates them, it might frustrate other people too. The way these models are evolving, we're going to be able to start our own businesses. You know, you'll just ask the model to help you start your business and talk about all the risks you face, but all the other opportunities that you might be able to harness. So I actually think this is a blessing in disguise, this hiatus as young people leave school and have trouble finding that first job. Here is a statistic or a chart that Dan Rodriguez on our team found. And, you know, the headline was first year of net out migration in the U.S. in recorded history. And, yeah, that was a little dramatic. What I find interesting about this chart, so they make a forecast there, and as you can see, forecasts have it in the best case leveling out to increase, in the worst case actually continuing to decline. But what I found interesting was while the net out migration was 2.9 million people, the net in migration was 2.6 million. Given all the headlines we see, you'd expect no one to want to come into this country. But 2.6 million wanted to. And, despite the visa crisis, I would say, here in this country, we were able to get Daniel McGuire on our autonomous technology and robotics team back from Ireland into the United States, St. Petersburg. Thrilled about that. So maybe the visa situation is easing because Daniel had to wait more than 18 months, I think, or roughly 18 months. And we thought it was just going to be a few months. So this was a little bit of an aha moment for us. Here's the personal saving rate. Again, a source of discomfort for some. There are a lot of people living hand to mouth. Food prices, on average, are still 30% higher than they were before COVID. And so they're still, in an affordability crisis. And the good news is this administration recognizes it and is starting to do all it can to alleviate that pressure, including reducing tariffs. Now, I know there's been a lot of kerfluffle, the Supreme Court ruling and so forth. And so we'll see how much of the tariffs that were put in place, or how many of the tariffs that were put in place over the last year will unwind. But it is a nice way to get affordability up in this country and maybe get the saving rate to stabilize. Because as the saving rate goes down, sure, it supports consumption in the short term, but then to get back to equilibrium where people want to have a little bit more for a rainy day, if the saving rate moves up, then consumption growth will slow fairly dramatically. Here you can see the everyday affordability squeeze. Now this chart, Dan White, portfolio manager with me, used Claude to develop, and it's a beautiful thing. It basically gives you a sense of how much COVID squeezed the affordability. And the red line is how many people feel they are experiencing hardship. And that is why the saving rate is going down. Hardship means they don't want to dig into their savings, but they have to. So we need these lines to improve. You can see that the purple one is flattening out, but it absolutely has to come down. If this administration wants to maintain its lead in the Senate, most people think they'll lose the House, but if they get the affordability crisis cured, going to be hard to do, in the next few months, by the time the election rolls around, that too might change. Here you can see another source of pain, auto delinquencies. So subprime is in purple there, overall is in green. Both of them are near records. Subprime is about to surpass the record after 08-09. That too says there is a lot of pain. Now, the reason 08-09 might have been lower than otherwise is because people back then, we didn't have Uber or Lyft. People needed to get to a job if they had kept their jobs. And so they defaulted on their home before they would default on their car. The car would be possessed right away or much sooner than the house was. So it probably would have gone higher, much higher otherwise. But still, it is shocking to see it near that level today. Now we'll go into how to cure this affordability crisis. Well, no tax on tips, overtime, and parts of Social Security, certainly helpful. I've presented this chart before. It is kicking into high gear right now. It didn't do anything in January, but the refunds really started in February, and they're going to hit their peak in March and April. So that's very important. And of course, this administration planned it this way, thinking about the midterm elections. So now we'll go into some other indicators. You know, honestly, I was shocked to see this metric, existing home sales, drop below 4 again, because mortgage rates have come down 100 basis points. So a little bit puzzling, but as I mentioned at the outset, housing starts and permits are starting to move up. So there are green shoots in this housing space. Here are new one-family houses for sale. That's inventory for the builders or inventory for someone. And you can see that it is now starting to improve. Houses are starting to move as prices fall and interest rates fall. So this is another green shoot. And then here you can, that was the green shoot. I guess I didn't have any other housing one. We'll go into market indicators now and talk about S&P relative to gold. There are some strategists out there that I respect highly who keep a close eye on this metric out of fear that we're going to end up in a 70s-style inflationary bust. We don't think we are. We think gold's ahead of it itself, and that the war here has caused some perturbations in the S&P, and so we expect this one to turn back around. And we're encouraged by the next one. Until recently, S&P relative to oil was near an all-time high. And you can see where we are at today's oil price. So it's come down a bit, but still near its high. Doesn't look anything like it did during the 70s. Here is Bitcoin to gold. Of course, we're very focused on the new global monetary system, which we believe is Bitcoin. We think this is going to turn around and are struck that we're higher than those last two big lows, even after all of the pressure recently on Bitcoin and the soaring of the gold price. So we expect Bitcoin to gold to turn around, and we expect it to happen both ways, the Bitcoin price going up and the gold price going down. And on this one, this is the commodity index. This is a manifestation of what I mentioned around the PPI. Input costs are going up, and you can see that they've gone up significantly enough where if consumer prices are not going up, or if they're only going up 1%, as Truflation says, there are going to be some margin squeezes taking place out there. And this is the chart that I still noodle over. It's just, my goodness, metals to gold. Gold hitting all-time highs and moving up so rapidly certainly is a part of this story. But typically metals would have followed by now, and they haven't. Sure, some of them are up. Copper crossed $6. Now it's back below. But we expect this to close maybe both ways, with interest rates coming down as more and more investors understand that we might be going into a negative inflation environment, and the metals to gold chart will turn up as the gold price comes down and metal prices participate in this budding, rolling recovery. So stay tuned on that one. And now here is what I mentioned very early and in the know. These are three banks. You can see the ones that we've mentioned below. And you can see that the private credit drama is not playing out in bank credit default swaps. The banks are not exposed to this particular crisis. And so that's reassuring, because anytime we see a crisis out there, defaults, fraud, and so forth, we wonder, is the banking system going to be impacted here? And so far, that answer is no. And the same is true more broadly for high-yield debt. So junk bonds relative to 10-year Treasury securities, that spread is near its all-time low. So not seeing any problems there as well. So that's quite reassuring. And with that, I will leave you for another month. Thank you very much for joining. And as I said, stay tuned. These charts are either going to come our way or go another way, and then we'll have some explaining to do. Thank you.